Holy. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, crisis protocols have been initiated as China's housing market crashes. And I want you to see what Beijing is doing to stop an all-out crash of its housing market that threatens not only to topple the banking system, but the entire Chinese economy. But what I want you to understand more than anything is how the U.S. economy is on the exact same path, and the same issues that are plaguing the Chinese economy are also plaguing ours. And before long, our political elites are going to be faced with the same dilemma. How do you prevent our economy from going from an all-out boom to a flat-out bust? Now let's head over to Bloomberg, where we picked today's story up with a headline: as China home sale slump drags on despite government rescue. And we warned about this in the past when Beijing stepped in and tried to save the housing market. We said this wouldn't work, and this is quite common that governments believe they can inflate massive bubbles through easy monetary policy or low interest rates, and then when it comes out and starts deflating, they believe they can put a stop to it. The problem is they can't. But this is the issue. This is not just plaguing China's economy, but every industrialized economy all across the world, including that of the United States. The value of new home sales from the 100 biggest real estate companies fell about 22% from a year earlier, faster than the 19.7% decline in July. Transactions slipped 2.43% from July, following a 36% on-month decrease. And the housing market is critical for every major industrial country all around the world, because if you have a strong and booming housing market, well, it leads to all sorts of consumption and demand across the broad economy. When you lose your housing market, well, you're about to lose everything else. An accelerating slide shows a waning impact on the latest rescue package unveiled in May. At least 10 city governments have loosened or scrapped new home price guidelines to let market demand play a bigger role, a move that is expected to drive more real estate companies to cut prices. And that's exactly what happens when demand goes down, and we're seeing that here in the U.S. We talk about companies like Walmart and McDonald's and Burger King and Target, and what are they all doing? They're trying to cut prices because consumer demand is down. You see the same thing happening in China. They're going to let go of the restraints, and that means, of course, builders and developers are going to be slashing prices, and that's going to have a knock-on effect to the resale market. The exact same thing we're going to see here, because in the United States, what do we note? That builders have one of the largest inventory of new homes since the 2008 financial crisis, except they believe they're going to clear all the inventory. What we know is they're going to be slashing prices, and that's going to force those in the resale market to cut as well. The problem is they don't have the margin, which means as more Americans hit the unemployment line during an economic slowdown, we're going to see a wave of delinquencies and defaults, just like we did back in the financial crisis. And the country has 382 million square meters of unsold new homes in July, equivalent to about the size of Detroit, if you can imagine, according to the latest official data. And we talk about bubbles, and this is exactly what happened in China. They built a massive bubble in property, and now they don't have the economic growth to support it, which means at some point either prices need to come down to a level that people can afford it, or the whole system is just going to fall in on top of itself, bring the banking system down. If you don't think Beijing knows this, they do. And on top of that, it's going to take the entire economy and then spread all across the world as we face then a globally synchronized recession. And cash-strapped developers, many in default for more than a year, are counting on a sales revival to persuade debt holders and fight off liquidation. And this is exactly what happens. We talk about debt-based economies where you see central bankers invert yield curves, they invert money curves, and they constrict the creation of credit. And this ultimately leads to an increase in defaults and delinquencies because there's not enough money to pay on all the debt. But naturally in the system there isn't. But in a debt-based system where you see this contraction in money growth, well, it leads to a big rise in delinquency and defaults, exactly what we're seeing in China. We look to the U.S. consumer. We see the same thing with credit card delinquencies, which is not in housing here yet, but it is in other areas. And here we see Dexon China Holdings in June became the latest builder to be ordered to liquidate by a Hong Kong court. Country Garden is considering extending payments on some of its yuan bonds again because they just don't have the money. So what happens is you force liquidation, you extend and pretend your debt out, hoping that something changes. The problem is, as we dig deeper into China's economy, we find out that nothing's changing. In fact, this is why we're going to see Beijing implement crisis protocols. Let's take a look at their mortgage stock because this now fell to the lowest level since 2021 as demand cools. And this is a big issue because what we know from China is they said they wanted to see the economy grow without large expansion of debt. The problem is in a debt-based economy, you need an expansion of debt. And without it, what happens is you start to get a contraction of money. You get a double-edged sword here. It cuts both directions. You don't have enough new money creating new growth. You don't actually have the existing money that's working in the system because it's being destroyed. But if you're looking to multiply your money, we've got the answer for you. Check this out. As of close August 30th, we got some updated information. I'm going to show you some of the new things we're adding to our programs. CTA Time Pro. We show you how to trade and beat the machines. Right now, we're seeing 16 open trades. 100% of them are up. We closed 2 trades out yesterday for a cumulative return 3.94%. Now, maybe you like to trade momentum like the RSI and the MACD, but you struggle with that. We aggregate all those together with a proprietary overlay. That's sitting on 5 open trades this weekend. 5 of them are up. We closed out 1 yesterday. That one's at 1.55. But here's the big deal. We added a proprietary system where we went back and ran the back test. Everyone said, Steve, do your programs work? They do, and we have the data to prove it. Let me show you in today's report. Here was one of the signals. Something closed above his 10-day volume profile and closed right as 30-day. But look at this. According to our backtest models, this signal had a greater than 50% success rate as a daily trade over a 1-month or 3-month time frame. Here's the buy it open, upside target and amount, and the stop loss levels. This is what you get. This is what we do for you. You pick the report, or maybe both. You get them both. You get the tradable signals. I give you my opinion on them. We give you the stop loss levels. We track all the trades and returns, and we give you the stop loss levels on an updated basis every weekend, fully duplicatable, 30-day free trial, and now backed by back-tested data. Soon that's going to be out to, of course, the subscribers, and then the prices are going up. You want to lock in, you need to get it now. Links in the description below, because the amount of outstanding mortgages fell to 37.8 trillion yuan at the end of June, the lowest since September 21. And that's about 3% less than their peak at the beginning of 2023, indicating that households have repaid more debt than they have taken out since then. And this is a huge problem in a debt-based economy because you need to see a continual expansion of debt to fuel growth. But when you get in a contraction of debt, it's a problem because only in a debt-based system can commercial banks create new money. So when a loan is paid off, the principal value of in any form, whether it's a monthly payment, quarterly, or all at once, that money is destroyed from the system. So you need to see a continuous expansion of debt, new loans taken out to offset all the old ones that are being paid down. What's happening in China is just going to add to the deflationary spiral. And it's a worrying sign that households and businesses are refraining from borrowing and spending, which could deepen. Here we see deflationary spiral and the persistent property slump. It's because you need new money growth. It's so critical. Economists at banks, including UBS, are increasingly see China's growth target around 5% slipping away because you need debt to get there. And that is the problem. China doesn't want that. Beijing said, look, we don't want to expand debt. The problem is if you don't, you're going to end up in a recession. You're going to end in deflation. It's not what you want because in their problem is you've got a massive housing bubble. You've got a Detroit-sized amount of unsold, unused homes. On top of that, the banks have lent to that. We know they're insolvent as well. You can see it's a recipe for disaster. But here's the evidence that, of course, a contraction in lending leads to deflation. Let's look at the U.S. data here. Well, we have the Consumer Price Index in blue against commercial industrial loans, and that's shown as of weekly data, also on a year-over-year rate of change. And what you can see is Disinflation takes hold as the CPI comes down, and what happens? You see a deceleration in commercial industrial lending, which adds to the downward pain of disinflation. You see that happen again here in the mid 1980s, but look, how about the 90s? You start to see a slowdown in lending, leads to a big slump in, of course, consumer prices. You see it here in the mid 90s. A slowdown leads the consumer price index. You see the dot-com bubble, it makes it worse. The global financial crisis, you get pushed into deflation. We see almost a double dip recession here coming out of the financial crisis. And what happens? A slowdown in lending makes it worse. You see this now, we're roughly right at the zero bar, unchanged, but this is likely to roll over and further push the consumer price index down, potentially at some point even threatening all-out deflation for the second time in modern history. That would be something, because we know that policymakers here say it can't happen and they have the tools to stop it. The reality is, next time we get down to 0% interest rates at the federal funds level, it's not going to stop anything. And the average rate of newly issued mortgages declined to a record low of 3.45% after rounds of policy moves, but many families are still choosing to pay down debt early because investment returns have also plummeted. You know, we talked about this in the show yesterday about how the savings rate in the United States has been declining, but at some point that's going to change, because what's happening is the U.S. economy is slowing down. Workers are seeing not much work for them. They're seeing the backlogs clear out. They're seeing friends, family members, and former coworkers hit the unemployment line not be able to find jobs. And when they don't see opportunity in the future, when they don't see the economy growing, they turn and start to save money and pay down debt, because the fear is they're the next one to hit the unemployment line and they need to be prepared because there's no opportunity. And this is exactly what's happening in China. Workers are not seeing growth internally. They're not seeing growth externally. Demand is coming down. They're paying off debt. And again, for a debt-based economy, it's absolutely the worst thing that could happen, because at some point, we talk about delinquencies earlier. When you have a shortfall of money, when you constrict the creation of credit, it's exactly what Beijing's doing. It's exactly what the Fed's done. You look at the consumer price index and you want to see a further deceleration in demand, we'll have people enter delinquency. You can see that here in the red line showing the consumer loans. As delinquencies rise, of course, banks cut off access to credit. When consumers don't have access to credit, they don't spend, and that means further disinflationary pressures. You can see that here in the global financial crisis led to all-out deflation, and now the trend is rising. As a matter of fact, historically it's relatively low levels, but if this continues to rise, watch out. Inflation is going to be the least of our problems here as we try to revive an economy that's going to head right into recession in the next couple of months, and arguably is in the early stages of it now. But as we look to China initiating crisis protocols, they're considering allowing refinancing of $5.4 trillion in mortgages, and this would allow homeowners to switch banks even. How about that? Could you imagine not being allowed to switch banks after you get a mortgage? Authorities are ramping up a push to reduce mortgage costs after the central bank encouraged such support last year, and banks responded with a rare rate cut on outstanding mortgages of first homes. It wasn't immediately clear if the latest consideration applies to all homes. And while lower mortgage rates would hurt profitability of state-run banks that are already well insolvent, authorities are facing renewed pressure to stem a housing-led slowdown in Asia's largest economy. And maybe finally the policymakers in Beijing get it. Because what have we seen recently? They wanted to drive long-term interest rates up because they didn't like the fact that they were too low. Well, instead of driving them up, maybe you should let people take advantage of them, and the more people that do, it would create demand for lending and lead to higher rates. Now, of course, the answer is, why is Beijing doing this? It's to free up cash flow. This is what's going to happen here in the U.S. This is why the Fed's going to eventually cut rates. Many people believe the response time of a rate cut is instantaneous. It does take time to feed through the economy. It takes months before credit card companies will lower rates, if they do at all. And next thing you know, where it's too little, too late. But the game here, free up cash flow, get consumers to spend, and maybe, just maybe if you're lucky, you can starve off that recession. Let's take a look at advanced retail sales against two-year treasury yields, again back to U.S. data, and why lowering interest rates does actually make an effect, but is not immediate. We can look back here into the mid-1990s. What do you see? A drop in two-year yields, a slowdown in retail sales, and it turned it around because it helped free up some cash flow for consumers. See that happen again here in the late 1990s. How about coming out of the dot-com bubble? You'll notice a big decline in yields did not have an immediate effect until we started to come out of recession, and then you see retail sales turn up. How about, of course, the global financial crisis? Persistent low yields eventually helped turn things around. Again, it all came back to people increasing cash flow and then having money to spend in the economy. It worked here when Fed Chair Jerome Powell cut rates in 2019. You see an increase in advanced retail sales, and now we're seeing a plunge in two-year yields. The question is it enough to turn things around? Well, the problem is it's not. It doesn't have an immediate effect. It's going to take some time. The reality is the U.S. economy is going to continue to slow. It's facing the same issues, just in a different way than China's. And if we implemented this, the move would send a signal that the central government is intensifying measures to support the overall economy, to protect household wealth and spur consumption. It would also indirectly help the real estate sector. It's not saying that at all. It's saying that all the policies that Beijing has implemented in the past didn't work. And they're getting desperate because there's nothing they can do to stop the fact their economy is heading to recession. Again, you have to look at China. They're the world's largest exporter. They're dependent on the rest of the world here. And the problem is the rest of the world's heading to recession. And Beijing should have acted a lot sooner. This is, while it is nice and will add some help, it's far too small to turn around a sinking ship. And here you can see that China economists at Jefferies Financial Group estimated the refinancing move could cut rates on existing mortgages by a maximum 1 percentage point, saving homeowners about 300 billion yuan, which presumably could get spent in the economy if they don't use it to pay off debt. And the move is going to be in the right direction if homeowners are allowed to switch banks for lower rates in the long run. It's more market oriented and better than a one-off reduction. It might boost consumption a little, but it won't have a material impact on the property sector, as home buyers already enjoy cheap rates, suggesting that yes, some of this money would get spent in the economy, some of it will get saved, some will go to debt payoff, but the idea that it's going to be turned around and used to buy another home, well, the odds of that are pretty low. The mortgage plan would add further pressure on the nation's banks, which Beijing has relied on to help revive the flagging economy. The banking sector is struggling with falling earnings amid record low margins, and this is just a last-ditch effort. Yes, it's going to be more pain for the bank. The hope is consumers go out and spend, because when we look at what's going on in China's manufacturing sector, it's bleak. It's getting worse, and this is why you're seeing, of course, consumers in China save, pay down debt, because they know what's coming, and it's going to get worse. As China factory activity extends, slide as headwinds mount. Check this out. The official manufacturing purchasing managers index declined to 49.1 from 49.4 in July. Keep in mind, anything under 50 is a contraction. The further below 50, the deeper the contraction, and the reading has been below the 50 mark for all but 3 months since April of 2023, indicating that the global economy continues to cool. There's a reason why Chinese consumers are paying down debt. They're not seeing any increase in the new order books. They're not seeing any new work. They're not seeing increase in demand. They know it's only a matter of time before more of them hit the unemployment line. And China's 17 trillion economy is struggling as prolonged property downturn weighs on consumers and businesses. Recent government efforts, including interest rate cuts to boost sentiment, have yet to turn things around. And this is important to understand, because here in the U.S., people believe in the instant power of rate cuts, and yet here we see in China, it's not having any effect. And when the Fed cuts in September, it's not going to have any effect either, other than hope. Meaning the economy continues to lean on manufacturing and exports in a slowing global economy to keep its growth target in sight. The non-manufacturing or services sector activity in construction and services rose to 50.3, which is virtually unchanged from the prior month, boosted by consumption during the summer holiday season. That compares with the July reading of 50.2, again, just above stall speed. External demand is also coming under pressure, with gauges of manufacturing in the U.S. and Euro area indicating a deeper slump in August. It all coincides. There's a massive slowdown in demand, and at some point, U.S. consumers are going to start saving. Chinese consumers are already paying off debt, because the reality is when you lose your manufacturing sector, it's exactly what's happening all across the world. And when we look here at manufacturers' new orders of durable goods, this is U.S. data against continued claims. As a slowdown in manufacturing persists, people hit the unemployment line, they don't have opportunity, they stay on unemployment, their spending drops, and next thing you know, it's not just the housing market, it's not just the banks, it's the overall economy, because what we're seeing in China, it's happening in the Eurozone, it's happening here in the U.S., and what it suggests is we're headed to an all-out, globally synchronized recession. China's housing market could be the first domino to fall. Maybe it'll be Germany's manufacturing sector. Maybe something will happen in the U.S. We'll soon find out. But by the way, keep in mind, there's nothing Beijing can do to stop it. They can do a little bit to cut the bleeding, but in the end, they can't stop the bubble from popping. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.